The governor made a very important point about trying to strike the right balance between dependence on bank financing and bond financing. I think one of the key takeaways from the European sovereign crisis is the sheer size of some of those banking sectors, the contingent risks that they pose to sovereigns. And I think we can collectively agree that we probably all underappreciated some of those risks. Where do you see Asia coming out on balance? Obviously, the banking sectors have remained resilient, but as our presenters have illustrated, the bond markets remain quite small. So perhaps you could talk about how you see the development of the bond markets and how that underpins the general improvement of creditworthiness in Asia going forward.
Okay, today I'm representing the group of the local credit rating agencies. As you know, the local credit agency is a bit different from the international credit rating agencies. But as the chairman of the ACRA, we've been rating some work for the development of the bond market in the region. But actually, the Asian economies are the least exposed to the so-called European sovereign debt crisis. And then still we have some kind of the benefit based on the, we learned a lot based on the lessons in European sovereign debt crisis and also the Lehman shock. In a word, I should say, be careful the European banks and then US banks, not the Japanese ones. This is the kind of the lesson that we've learned. And actually, this global, say, financial crisis gave us the opportunity to recognize anew the importance of the bond market in the region. So ACRA was established back in 2001. We've been gradually doing some kind of seminars and workshops how to contribute to the development of the bond market in the region. So actually, as mentioned by the Mr. Stromer and also the Mr. Governor, we still have some space for the corporate bond issuance. Actually, volume of the outstanding, saying that 10 years ago, only the, say about 400 billion US dollar equivalent, say by the 8 Asian countries. But now it rose up to 12 times and then amount up to the, say, around 5 trillion US dollar equivalent. But there still is some space for the corporate bond issuance. So in that sense, some kind of the, say, effort needed how to enhance the cross-border investment in the region.
Michael, maybe I can turn to you. Again, in the governor's opening presentation, he kind of alluded to the fact that S&P has downgraded more AAAs than some of the other rating agencies. And we would love to hear about the lessons learned from, I think, this crisis for you all. How you approach ratings, has it changed? And maybe talk about it through the lens of Asia. I think Asia has probably differentiated itself in terms of how it's regulated its banks, heavier reliance on macroprudential type regulations. Should we expect further upgrades based on kind of the status quo in Asia, or are you looking for a deepening of the bond market and a diversification of funding sources? Maybe just walk us through the lessons learned and the way forward.
Okay, thank you, Philippe. Yes, and the governor also talked about the convergence of credit ratings in developing markets and highly developed ones. And that certainly appears to be the case. I think over the past 10 years after the impact of the Asian financial crisis of the late 1990s had been fully digested, the overall direction of credit ratings in emerging markets has been up, while that of ratings in developed economies has been down. In 2011 alone, we upgraded close to 20% of our speculative grade ratings, which are highly populated by emerging markets, of course, and we similarly downgraded close to 20% of our investment grade ratings, which again are biased towards developed economies. And you look at some examples. For example, Japan and China now are rated the same by Standard & Poor's at AA-. Japan, though, has a negative outlook. So, yes, I think we can expect some further convergence. It's possible in the long term that we will see many emerging markets catching up with developed economies in terms of credit ratings. But I would caution against the risk of extrapolating from the trends over the past 10 years and just drawing a fixed line into the future. It is difficult to be in the business of predicting the future, but if anything, drawing straight lines will lead to the wrong direction, the wrong conclusion. Our expectations for credit ratings in Asia Pacific actually this year are fairly balanced. Our basic assumptions, and these really concern the global environment, are for a relatively mild recession in Europe, a continued rather tepid recovery in the US, and a soft landing in China. But that being said, Asia is not decoupled from the rest of the world. The greatest danger probably to the region is what is happening in the Eurozone. If we were to see a deepening or an acceleration of the recession there, or changes in market sentiment, it could very well impact the region in terms of reducing exports, perhaps impacting capital flows, reversing capital flows. The region, of course, is also exposed to a possibility of increased energy prices. And in that kind of difficult environment, where policymakers would be torn between trying to tame inflationary pressures and budgetary pressures, there's a possibility of some either policy mistakes, policy reversals, or policy paralysis. So, in conclusion, some possibility of improvement over the long term, but there could be hiccups along the way, and certainly the environment is the environment in the coming years is a difficult one. On the subject of the debt capital markets in the region, we've been extremely pleased, and we're very optimistic about the continued development of the domestic debt capital markets. That's been a tenet of policymakers in the regions after the financial crisis, and a number of measures are continuing to be put in place to develop those. And I think they will help also in helping the region cope with possible external shocks. I'll leave it at that.
Thank you, Michael. Turning to Jennifer, maybe I can follow up on the question I asked Michael and hone in a bit more specifically. And at the risk, I think, of being a little bit provocative and maybe overly simplistic, if you look at the West, they were obviously, many of those countries were richer than the Asian countries. But for many of the other balance sheet metrics, growth dynamics, debt to GDP, external type factors, Asia performs better. Would you, again, linking it to bond markets, is one of the constraints for all issuers and the credit ratings across the spectrum going forward in Asia, simply that they just don't have, access, to long-term local currency financing, the way we do in the West? Is the debt tolerance of corporates and governments in this region lower as a result of that? Or, what explains the differences, I guess?
Philippe, I don't remember in the briefing that I was entitled to get the provocative questions, actually.
I will ask increasingly provocative ones going
So
forward.
I will follow up on that with you afterwards. I think, to answer your question, that the very short answer is no. I don't think that operates as a restriction in and of itself in terms of the credit rating fundamentals of the Asian countries versus the Western countries. I think, a very important issue that's been discussed by a number of people today in terms of, what lessons have been, learnt from the recent Euro crisis and financial crisis. I think it's quite interesting to answer it with another question, and at the risk of being too simplistic, that I think what has become more evident in the way that the Asian countries have been able to withstand the crisis is how well they learnt the lessons from the Asian financial crisis. And I think that that's a really interesting point for discussion, perhaps for some of our European country colleagues at this point in time. Because if you look at, again, along the lines of some of the comments that Michael made as well, during the course of the financial crisis, generally the credit ratings of the Asian countries have moved in a positive direction. And I think there are a number of key reasons for that. Relatively consistent across the region. Obviously, they vary from country to country. But if you look at the fairly strong and improving fiscal position of their various governments, many of the countries have very strong banking sectors, very deep, very liquid. There's been significant policy changes in terms of regulation. And of course, many of the Asian countries have been in the enviable position of having strong economic growth. But if you look back at some of those issues, many of those are the result of reforms that were undertaken after the Asian financial crisis. So the banking sector restructuring that occurred, some of the policy changes that took place, the reduction in reliance on external debt and so on. So I think that has really positioned the region very well to weather the current crisis that we've seen now. And it'd be interesting to hear some discussion in reverse, if you like. Have the European countries and other parts of the world understood how well Asia learnt the lessons from its crisis earlier and responded to that? A good discussion, I think, going forward. Certainly, Asia is still impacted clearly by the global financial crisis and currently in particular, macroeconomic pressures from the Eurozone. But interestingly, they don't seem to be undermining the strong credit fundamentals of the various Asian countries. Many of the Asian economies are very open, export-led, as you all know far better than I, and they will be hit by a reduction in demand from Europe and the US. But nevertheless, what we're not seeing now is that will lead to, as I said, significant reduction in credit strength. So a long way to answer your question, I know, but I don't think the fact that Asian countries have been, not at the same stage of development, perhaps in developing liquid capital markets, has impacted their credit strength in other ways. And in some ways, the question might be, for a number of countries, but not all, the fact that their capital markets were less open, in fact, they benefited from that during the financial crisis. They didn't have the quick outflow of money that we saw. They weren't in certain markets. Indonesia and India come to mind, but it's probably true of many Asian countries. They weren't exposed to European banks in quite the same way. So in some ways it benefited them during the recent period, but I don't think it was the main course of credit strength in the Asian region. I think it was really about the structural reforms that many countries were able to put into place over the last decade or so.
Okay, I appreciate that. I think that's you raised some very good points, and so maybe back to Dr. Imai. I guess I would ask if you broadly agree with what Jennifer said, and when you think about the lessons that were learned by Asia, have they moved aggressively enough post '97 in terms of building domestic bond markets? I was struck by Mr. Hong Tran's presentation, looking at the investor assets under management. You do have high savings rates in these countries, and seemingly not enough of it's being channeled into bonds. As a question, is it a demand-driven story, or do we not have the supply from governments or corporates? Is it a little bit of both? Maybe you could talk a bit more about that dynamic and what steps you think policymakers need to take in the region to accelerate it.
Before that, I want to say one thing. I'm still wondering, she said Asian countries' ratings are moving positive or forward. But actually, I'm wearing two hats. I'm representing the Acura, and also I'm advisor of the Japanese International Credit Rating Agency called JCR. Always the rating given by U.S. giants to the Asian sovereigns lower than that given by JCR. 10 years ago, maybe 1 to 4 notch difference to certain Asian sovereigns. Now, after 10 years, still the 1 to 3 notch difference between JCR, Japanese International Rating Agency's rating, and U.S. giant S&P Moody's. So maybe some kind of the fundamental, basic methodological difference. But one thing I've learned when I tried to establish the Acura, I made some kind of field study in the region requested by Japanese Finance, Ministry of Finance. And then I was advised Malaysian government and the private sector, and then Hong Kong, and also the Hong Kong, Malaysia, and yes, Philippines. Actually, U.S. giants approach a bit different, and then they put stress on the data figure itself. But JCL's approach to sovereign ratings put more emphasis on the qualitative side. That might be some kind of basic difference between U.S. giants rating to the Asian sovereigns and ours, something like that. That's one thing I want to say. But actually, we've learned a lot of things, from the Lehman shock and Asian credit crisis, 1997. And then, but we have to think about this kind of the thing. Certain Asian countries suffered some kind of, say, a certain capital flight, and also some years after, certain excessive capital inflows. So in that sense, we have to have some kind of gadget, how to cope with these situations, excessive capital inflow, and also the other way around, a very sudden capital flight. That is the development of the bond market locally. That's very, very important. That's why the Acura was born, but still ahead, we have some kind of the new international financial crisis. Risk of the Asian government lies in this kind of the possibility that financial market might harbor the similar concern about the management of those Asian countries about the public sector bond debt, because European debt crisis. Actually, no more government guarantee worked. Government guarantee worked. No more government. Then how we can cope with it? Very difficult. So maybe some kind of the, say, international, movement toward the risk aversion. So maybe it might cause a rise, some kind of the aversion, to avoid the, say, international investors leave the region. So we have to cope with this kind of thing as well. So in that sense, some kind of groundwork of the development of the local bond market is very, very important.
Thank you for that. Michael, I'd like to seize on something that Dr. Imai mentioned about methodological differences. I know that both within the rating agencies and also third parties, there have been some studies that have kind of isolated GDP per capita as one of the main drivers of ratings. And I think part of that is because we assumed rich countries had stronger institutions that afforded them a greater policy flexibility in terms of managing shocks. And I think, the crisis in Europe might at the margins be calling some of that weight that we've placed on that metric. And so the question is, have we given too much credit to countries in the West and maybe not enough credit to developing Asia? in terms of their ability to kind of cope with and manage economic cycles? And is there a rethink that could drive, additional ratings upgrades here?
Thanks, Philippe. Well, yes, as you pointed out, GDP per capita is one of the elements that we look at in our criteria for assessing sovereigns. It's one of 5 broad factors. We look at GDP capita as one element in assessing what we call the economic score, where we look at the resilience, diversity of the economy, also at its growth prospects. And the assumption there is that high GDP per capita is the result of solid institutional arrangements that in the past have been able to deliver prosperity to the citizen. So it is a backward looking way of assessing the institutional strength and the ability to deliver strong policies. Now, whether we're putting too much weight on it, very difficult for me to say. Maybe we should have this dialogue 10, 15 years from now. And the reason why I'm saying that is that the way to assess the performance of credit rating firms is to look at their default studies. We've just updated our default study on sovereigns last month. It's publicly available. It's extremely detailed. It's based on 128 sovereigns, which is a large number, but it's statistically not that diversified. It's not a statistically significant sample, but still it shows an extremely robust performance of credit ratings. And what's interesting is that even though that sample is not that statistically significant, it's broadly in line with the rating performance of our other asset classes. For example, well, there have been no defaults of AAA or AA's yet. But there's been 1% of single A's that have defaulted. That's Greece. That default has been very helpful to our default studies last year. About 5% of triple B's have defaulted. Around 20%, I think, or 15% of double B's. A bit higher for single B's, and then over 80% for triple C's. So based on our default studies, performance has been very robust.
Maybe one more question from me, and then we'll open it up to more interesting questions from the floor. Back to Jennifer, if I may. The governor highlighted there's both, pros and cons, obviously, with rising cross-border capital flows. We do have relatively shallow bond markets still in many of these countries. And obviously, with all the Western institutional investors now coming into Asia, you've even got central banks starting to buy up each other's government bonds. I mean, how does that play out? And from your perspective, do the pros outweigh the cons? And how do you, as a rating agency, come out with kind of what is the appropriate measured approach towards deepening these markets and opening them up to cross-border investment?
I think the issue, when we think about it from a credit rating perspective, is to understand, the nature of investment that is going into a particular country. What is required, where is it coming from, those kinds of issues. And I know that, John Sturmer talked about the issue of not only, if you like, global money going into Asian markets, but Asian money going into other Asian markets. So I think to the extent that there is the ability to create an open, deep, liquid domestic market, there is potentially the ability for a country to have ongoing sources of investment that it can help it support its growth. And it seems to me that that's probably the key issue that we need to think about when we're talking about the development of capital markets. What's our objective in wanting them to be developed? What are we trying to do? And I think what we're trying to do there is facilitate capital flows in order for there to be, ongoing investment into a given country. The way that needs to be done, I think, is, obviously really not particularly a question for rating agencies. I think we can have a role to play in facilitating that by assigning, credit ratings, which we think of as being, the language of credit, so people who are not necessarily familiar with every detail of that country or that credit, have an opinion that they can use as a starting point for analysis. But there are clearly lots of other measures that need to be done in order for markets to become open and transparent. So it's not simply around use of ratings or regulation of rating agencies, but around the type of regulation that a particular government would like to put in place. And of course there are issues there that needs to be aligned with their own policy decisions as well. So a lot of different issues around opening up of markets, but I think very importantly understanding first off perhaps, what is the objective behind wanting to do that.